Welcome to Wealth Matters Podcast. I have with me Ted Lanzaro, who is a certified public accountant, and he calls him as a CPA for real estate investors and entrepreneurs. And that's what I like. I'm a real estate investor. I'm an entrepreneur. So I always like to talk about taxes with, whomsoever I meet with. And that's how, Ted and I started chatting. Uh, himself is a real estate investor. That's another good thing to have in a CPA. He's a broker, author, speaker with more than 29 years of real estate tax consulting and investment experience. He runs Lanzaro CPA LLC, a boutique CPA firm specializing in accounting and taxation for the real estate industry. Mr. Lanzaro is the author of the Tax-Smart Landlord and the Tax-Smart Landlord toolkit as well, as over 100 articles on taxation for the real estate industry, specifically for investors, landlords, flippers, and developers. Welcome, Ted.
Thank you so much for having me. I appreciate you having me on Wealth Matters.
Absolutely. And hope I did justice to your bio. Feel free to add if I forgot anything.
Oh, you did a great job. Yeah, I've been a CPA in the real estate industry for 29 years now and been an investor for 20. So.
Nice. Yeah. So I just started investing about 10 years ago. So you are way ahead of me.
Well, everybody had to start somewhere, right?
Right. Yeah. And you're right. Everybody has to start somewhere, and don't compare your journey with someone else's, right? Means you don't know what they have gone through, right?
No, that's true. And that's sort of how I got started was, looking at the people that I was doing tax work for and going, wow, these people are really making some money. And frankly, they're no smarter than I am. I think I can do this.
Right. That's awesome. Tell us something interesting about yourself.
Well, like I was saying, I've been a real estate investor for the past 20 years. Other things that interest me, I've always been sort of a motivational kind of junkie. I like all of that, kind of motivational stuff. I was watching and reading
like Jim Rohns and Tony Robbins and they're amazing. Yes.
and I've been reading and listening to podcasts and recordings.
Yes.
And stuff for 20 plus years. When I started in real estate investing, Ron LeGrand was the big
real
estate guru.
That's a while ago, yeah. So when did you start in real estate, and how did you end up in real estate? What was your thought process?
Yeah, so I was working for a CPA firm in their real estate department doing tax work, and a buddy of mine that I had gone to high school with, called me one day. He's like, "Let's have lunch." He said, "I want to talk to you about something." And we go to lunch, and he hands me this book, and it's a book every real estate investor in the world has. Rich Dad, Poor Dad.
Of course, that's why I started laughing. It has to be that.
And he's like, "You got to read this book, right?"
Yeah.
And so I read the book, and I was like, I said to him, we met again, and I said to him, I represent a lot of people in the real estate industry, and they're really making money. I think you're right. I think we should go out and we should start doing this. And he and I went out. The first time we went out looking at houses, we went out looking at single family houses in Fort Lauderdale, Florida. And the first day we were out, we put contracts on 3 single family houses as rentals, and we bought all 3 of them.
Wow.
And we ended up fixing them up a little bit and renting them out. And that was like sort of our first kind of foray into the real estate business. In about 2 years, we had 3 more of those houses. We had a couple of garden apartments, like these little apartment complexes. And we were also we had started flipping properties.
Oh, wow.
Houses and fixing them up and converting them. And it was funny because at one point we sort of ran out of money,
Right.
And we ran out of money and bankability. Like we had too many loans.
DTI, yes.
Yeah, we did make some mistakes. Like we put both of our names on all the mortgages.
Wow.
So that was kind of dumb because as soon as we had, like when we had 6 houses, that was it. The bank told us we
Right.
couldn't buy anymore. So the so we were doing some flipping, like I said, and at one point we had to take in a third partner, right? And so what was kind of interesting about that was that this particular partner, who was also a friend of ours from high school, was very conservative. My
Hmm.
other partner was the complete opposite. He would buy and do anything, right? And I was sort of the middle guy, the guy who was like kind of trying to balance both of them, right? What I think was interesting, and what's a very good lesson for real estate investors was we we did very well and we made a lot of money, but we also left enormous amounts of money on the table. And I'll give you an example. There was one deal that we did, and this was a time when the market was really rising. We could have bought this property in Vero Beach, Florida, on the 3 doors from the beach. And um, my very conservative partner didn't want to do the deal because it was too far away. It's only 2 hours away. It's a lot of money. We were going to pay like $350,000 for the house and put another 100
Hmm.
into it. Blah 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 blah. So we didn't do the deal, right? So now, a couple of years later, I'm up in this part of Port St. Lucie, Florida, like about an hour north of where I was living, and I run into a guy who did that house. He
Oh,
bought that
okay.
house. He fixed it up. He made $400,000,
Cool.
right? So it was we did really well, but we also made some mistakes, and
Right.
so you can't be afraid to take chances,
Yeah.
and you have to kind of go with your gut. That was one of the things that I learned very early on.
That's awesome. Yeah. So you got to take your chances. You have to pull the trigger, right? So how did you figure out that the real estate investors need help with taxes? Right. Because most of my friends, they're W-2 employees and they're, oh yeah, we are using TurboTax. Of course, I have my CPA. But real estate world has lots of, tax advantages. So when did you figure out that you want to focus on real estate investors and entrepreneurs?
Yeah, it was interesting because during the time that we were building that portfolio, and this was around 2002, 2003, I started going to a lot of real estate investment club meetings. There
Uh-huh.
was a lot of local clubs in the area, and just to network for deals and talk to other investors or whatever. And one of the guys who was running this at the time, it was called the Treasure Coast Real Estate Investment Club, found out that I was a CPA and that I worked, like in a tax department for real estate. And I was also an investor. And he's like, well, what strategies are you using for your investments? So I kind of told him what I was doing and that sort of thing. He's like, would you get in front of the room next meeting and do a presentation about all the tax strategies that you're using? I said, well, I've never done that. Frankly, I had no public, speaking
Speaking
experience.
experience.
Nothing. I do it now second nature. I can walk in front of a
Right.
room without even a script and just start talking real estate, right? And nobody would really know the difference whether I scripted it or not. But back then I had never done it before, and I literally got up with my 14 slide PowerPoint, and everything was written out. I literally just read my PowerPoint to the crowd, right? While my knees were shaking, underneath me.
Right.
But when I got to the end, everybody clapped. And, when I was done, a crowd of people came around, everybody had questions. And I left that meeting with about 5 new clients, right? People
Nice.
who were interested in doing business with me. So I was like, look, I said, this is kind of an interesting market. I'm doing this anyway. And this is also about the time where I decided that I was going to leave the large firm that I was working for and go out on my own. So I sort of got this like entrepreneurial, kind of surge from the investing, and decided, well, I'm going to, do my own business too. I'm not going to work for, this bigger firm anymore. And so those clients really were the start of my first client base. And
Nice.
all I did from then on was go to meetings, network with people, hand out cards, talk to people, and I literally built a tax practice along with my investment portfolio between 2002 to about 2006. I built up a CPA firm, all investors. And then I decided that I was going to move back to Connecticut, where I live now. So I sold that CPA practice in Florida. And my partners bought me out of our real estate investments in Florida. And I moved up to Connecticut, and I literally started an accounting practice here from scratch. The first day I literally had no clients. And I just started, calling and going to investment club meetings and continued my investing. I had a We Buy Houses van that I used to drive around in and go look at properties. And I was flipping houses and building my accounting practice. And now, it's turned into, a really, really nice business. Basically, I don't know that I could do much more accounting and tax work than I do now. I've got a jewel of a tax consulting practice.
Nice.
Full of great clients who, I do really good stuff for. They appreciate it. And, it's a lot of work, but the tax strategies that we use, help them save literally thousands, tens of thousands, of dollars every year.
So now let's get to the meat of the podcast, right? You got to spill the beans. Can you take us through the strategies for real estate investors?
Yeah, and look, and we'll start with that. So my book, The Tax-Smart Landlord, is full of 39 tax strategies for real estate investors.
Okay.
And the first and the most important kind of thought process that goes into that is twofold. One, everybody's different.
Right. Oh yes.
So everybody has a different situation. So I see sometimes on Facebook people talking about tax strategies and my CPA said this and my CPA said that. Well, that's because you're different people and you have different situations.
It's like fingerprint. The tax returns are like fingerprint. They are different.
Well, and different rules apply differently to different people based on their situation, right? So one person can deduct something and another person can't. And the reason is, well, you're an active investor versus being a passive investor. You're a real estate professional versus being a passive investor.
Right.
You're married versus being single. So there's some credits that where people are married, you get the credit. If you're single, you don't get the credit.
Yeah, you got S Corp, C Corp, right? LLC taxes, partnership. That's all
different entities, like you just mentioned, right? All the different kinds of tax entities. So that's the first thing. Everybody's different, right? So tax strategies need to be tailored to the person's unique situation, and that's literally what I do all day. I look at somebody's tax returns and their situation, and I structure it for them to save the most amount of money. The second thing to keep in mind is that really good record keeping helps.
Yes.
Really good record keeping is the foundation of all good tax strategy. So it's much easier to do tax planning and tax strategy for somebody who's well organized and has good records, because they can give you the numbers. They can say, oh, okay, through November 30th, this is how much money I made. Right. So now we got a month to kind of structure that, get the money down, help them do things. And that's like literally October, November, December. All I'm doing after the October 15th deadline is structuring people's end of year to save them the most tax money. So now some of the tax strategies that we use. So I've sort of in the book, I've divided them into tax strategies for buying, tax strategies while you're holding, and tax strategies when you're selling. And it's way too much stuff to go through in one time. But let me give you tax strategies when you're buying, right? Pretty much twofold. So somebody calls me and they say, look, I'm buying an apartment building, right? We're going to do some work up front, need some work initially, right? All right, great. Well, how much did you pay for it? $2 million. Okay. Can you guys, are you real estate professionals? Can you deduct bonus depreciation? Yes, we can. Okay. Cost segregation study. No brainer. divide, get an engineer out there, do the study, get the depreciation breakout proper, get all the 5 and 15 year
Yep.
tangible personal property.
And we have spoken about cost segregation with Yona Weiss. He was on the
Right,
podcast,
yeah,
and we
yeah.
spoke
He's
about
one of
cost
the, he's one of the
segregation.
best guys. He's one
Right.
of the best guys out there. I really like him. Very
Yep.
nice guy. And so say you get a guy like Yona out there and they do that work and you get the report back, and then from that I would prepare the depreciation schedule for your tax return. And now we're going to carry that out. Maybe we're going to send it out. We're going to divide it up amongst whoever the partners are in that entity, and some of them who are real estate professionals are going to be able to take that deduction, and the passive people may or may not, right? So that's sort of like, kind of a basic one, right? But it's something that a lot of people don't do, right?
Right.
Now, take that down to a smaller level, right? So take that down to the guy who just buys a 3-family house, right? And here in Connecticut, maybe you go out and you buy a 3-family house in, say, New Haven, Connecticut, where Yale University is, a lot of student housing.
Uh-huh.
You go out and you buy a 3-family house, and maybe it costs you $350,000, right? Well, you're not going to get your firm out there to do a $350,000 cost segregation study. It's not enough money, right? But that doesn't mean that you can't go and break out all of the basic 5-year property, all of the appliances and cabinetry and all of that. So I teach people how to do that, it's not as bulletproof as having the engineering study done,
Right.
but you should be breaking out the basic stuff.
Okay.
Right? And the same thing for, land improvements, the same thing for the parking lot or the driveway or whatever. Break that out. Not as fancy as cost segregation, but you're getting the basics, right? Now, if I'm doing work, I'm also keeping track of all of the stuff I'm throwing away, because all of the stuff that I'm throwing away, I can take a tax deduction for.
Right.
I paid for it, right? So now I'm going to make a list of all those things. I'm going to take pictures. I'm going to do all the proper record keeping. And then I'm going to basically give them a value, and I'm going to deduct that value off of the cost basis. So those are when I always tell people, look, call me whenever you buy, renovate, or sell the property. I want to know if you're a client of mine, because those are the strategies that we're going to put in place. And I'm going to teach you how to do that record keeping along the way, so that when it comes time to do your tax return, you've got all necessary information. Now, when you're holding a property, everybody knows that you can deduct the mortgage interest and the property taxes and the insurance, right? But what a lot of people leave off of their tax returns, and I catch this all of the time on people when I look at people's returns, is they forget the kind of administrative stuff that is deductible, right? And but it's not the property stuff. It's not the repairs of the mortgage interest. It's stuff like the miles that you drove to manage your property.
Right.
It's an allocation of your internet. It's an allocation of your cell phone, right? It might be the office supplies. The other thing, and people leave that off. And look, it doesn't have to add up to a huge amount of money. If you leave $2,000 off your tax return, it probably costs you $500 or $600, right?
Right.
So like where cost segregation is a huge strategy where you're going to save a ton of money, there's also a lot of smaller strategies that you save, $500 here and $600 there and another $500 here. But when you add it all up, right, and you integrate it, it can be a couple $1,000s of tax savings, right?
Yeah.
And while that may not be a huge deal to a big landlord, for a lot of my smaller clients, who just have like small multi-family portfolios or whatever, though that stuff adds up, right?
Yes.
So those are the kind of holding strategies. And then you have, selling strategies, and that's all going to depend on, what kind of gain you have. So first, we talked a little bit about the Tax-Smart Landlord toolkit that kind of goes with the book. Well, a lot of that is like different spreadsheets that I've designed to help investors, calculate gain on sale. Not a lot of people even understand how to calculate gain on sale, right? But once you know the gain on the sale, right, then you can make a decision. Is it worthwhile to do a 1031 exchange? Can I do a 1031 exchange, right?
Right.
Replacement properties aren't falling off trees these days, right? And
Right.
there's no sense on buying a bad property
Exactly.
if you're, to save, you'll ultimately lose money,
Yeah.
even if you save on taxes.
That's
So,
what my gripe is with 1031, that you have 30 days to identify 3 properties and you have 180 days to close on one of them. And lots of time you end up buying a dud, right?
well, and that's possible, right? And what I tell people is right now, what I'm telling people is don't 1031 until you find, like, I wouldn't even sell my property right now
Yes.
unless I found something that was better, right?
Yep.
So if you've got properties that you're making, say, 10% return on investment on, just to use a round number, right?
Right.
Well, why would you sell it so you can go turn around and buy another property where you're going to make 6%? That's silly.
Yeah.
Why would I want to make less money?
Lower return. Yeah.
Right. Why would I want a lower return? And you know what a lot of people say? I'm bored. I've owned this property
Yes.
for 10 years. Right? That's why I'm selling it. I'm bored
And
of
it
it.
happens. Yeah. I've been through that as well.
Right?
But I'm like, okay.
So, yeah, people get bored making money. Oh, it's a cash cow. I'm really
Yeah.
bored with, the cashing those checks. Right? So what I tell them is, look, if you've got 10% properties, don't do an exchange until you go out and find the 12% property. You find that great property, that next one that you want to buy, right?
Mm-hmm.
This is tax strategy, but it's also investor
Right.
strategy.
It's
This is sort
investment
of what you
strategy.
kind of
Yep.
get with me is both a tax and investor mindset. But it's okay, go and find that 12% property, right? Because I know now in this market that I can turn around, put my my properties. If I find a better property, I can take my 10% properties, put them on the market, and probably sell them in 3 days.
Right. Right. That's true.
So I'm going to find the better property first, then I'm going to go and sell the ones I need to sell to do the exchange.
Right.
Because I've already identified, I don't need 45 days, I've already got it. Right? So, the other tax strategies that we're using, and I just did a webinar for a Rhode Island group on this, is a seller financing.
Yes.
Right? Not
So
very.
it's similar to monetized installment sale, right?
Yeah,
Yes.
exactly.
It's yeah.
And it's not super popular right now because money's pretty cheap, right? And it's
Yes.
relatively easy to get a bank loan.
That's
But for sellers, especially ones who've owned properties for a long time,
yes.
it's a great strategy, right?
Yep.
So I've got a deal coming up pretty shortly. I have a brokerage also, so I do some brokering for my clients, right? I run a brokerage, and one of my clients wants to sell a property, right? But he's got no cost basis left in it. He's owned it for almost 30 years.
Yeah,
Right?
you have depreciated to the bones.
It's done. The depreciation is gone, right? So I told him, look, he's like, well, I want $1 million for the property. He's like, but I'm gonna have to pay tax on $1 million. I said, well, ultimately, maybe, but would you do an installment sale? Would you hold a note? Because he's tired of the management, but he's not tired of the money, right? And he can't put it anywhere where he's gonna make what he's making on this property.
Right.
So I told him, I said, look, I said, if somebody offered you 400 down, would you give them a mortgage for the other 600 so that you could save the tax on the 600 over a month? He's like, yeah. He's like, I would do that. I said, well, you get payments like $4,000 a month or whatever. Really? Wow. Yeah. You probably could get 5 or 6% interest. That's more than you're going to get.
Right. And it's just
great.
steady cash flow, tied to the property you already knew about, right?
Right. Exactly. Now, what that does for him, not only does it save him on taxes, right? But he also can ask for a premium on the sale of the property, right? Because he's given great terms.
Yes.
So instead of say I want $1 million, he could say I want $1,050,000 or I want $1 million,
right?
Because I'm offering great terms. You don't have to go to a bank, but you need to come up with $400,000 because I'm not doing 10,000 down and
right.
990,000 mortgage, right? But still, it's a great deal. He's going to end up making a lot of money. He's going to defer the taxes out probably. He won't go. This particular guy probably will have like a 7 or a 10-year balloon, right? but so he'll get all of his money within 10 years, but he'll still have stretched the tax out for 10 years, right? You can do something similar with opportunity zone investments.
Yes, I was going there. Yeah,
Right.
that's
So there's a few more rules and some peculiarities that you have to kind of follow, and you would want somebody like a good attorney and a good real estate CPA on your team to make sure that you're doing all of this right. But the opportunity zone properties, you can defer the capital gain on a sale of a property up through 2026.
right.
And get a step up in basis on the property that you buy as a replacement, right? So you have to use capital gain money, but you can defer. So it's 2020 now. You still have 6 years worth of deferrals left, pretty much, right? And whatever step up. Now, now let's talk from an investor. So that's the tax side, right? Now, an investor would say, okay, well, but are those great properties?
Yes.
Some are, some aren't. It's just like anything else. So you can go and buy really nice properties that need work in an opportunity zone that could really make you some money, and you could buy something in the middle of the worst part of town that is never going to see gentrification ever, right? And so while it's a good strategy, it's situational.
Yes.
And it has to be done right. From an investment, it still has to be a solid investment.
Oh, absolutely. And one of the advantage with opportunity zone is that you can also roll over money from stocks, bitcoins, and whatever kind of investment. So it's just not real estate. So I think I call it as like it's 1031 on steroids, because you can pretty much bring capital gain even if you have sold a business.
Right. And if you're a syndicator,
yes,
and you're trying to do a syndication and you do an opportunity zone syndication, you can bring in capital gain money from people.
Oh, right. Yes.
Into the opportunity zone syndication and help them defer their money. Right. So I've got a client who's doing that right now, and he's been pretty successful at it.
Nice.
Yeah.
So, and I have heard about the other strategies, the DST, Delaware Statutory Trust, or the Deferred Sales Trust also. So how do you compare like 1031 to seller financing to opportunity zone fund to Delaware Statutory Trust, and there is also Deferred Sales Trust? How do you compare them when you see an investor? How do you figure out which strategy would?
Again, it's situational. It's looking at their specific situation, what they're trying to accomplish, and whether or not, like, think about it from this standpoint, right? The 1031 only works, like what we were talking about, only works if you can find the other property.
Right.
Now you can 1031 into Delaware statutory trust deals, right? Okay. So I've got another client that we're gonna probably end up doing this with a really large sum of money, right? So I have a guy who works for my brokerage who's an expert at this, at sourcing these deals, right? So he sources 1031 deals and he sources Delaware statutory trust deals. He's got all the right licenses to do that, right? In addition to his broker's license. So we've got a client who we've got to place about $30 million for, right? And so we were trying to show her what a Delaware statutory trust portfolio would look like, because it's a whole bunch of different investments. You're not popping it all into one syndication.
Right.
You've got to bust it out, right? Into diversify it. So we were able to do that. Really nice returns, kind of gets her, the same sort of money she was getting before, hopefully, from her investment. And this is pre-COVID. Then COVID hits.
Yeah.
And these investments disappear, right? Because the thing with the Delaware statutory trust is they're syndications, right?
Yes.
So they as soon as they fill up, that deal's off the board, right? Well, that's what happened. Now, and what ended up happening what's going to happen with this client is she's not going to end up closing on her deal until the end of this year. the fact that it's still alive is amazing.
That's great.
But it's still alive, right? So now we're slowly starting to see those Delaware statutory trust deals start coming on board again, right? And some of these triple net kind of deals,
Right.
where you buy like a triple net building.
Triple net lease, and
they're coming back.
yes.
Right? Well, they disappeared for a while, right? So anyway, it's all about what the client is trying to accomplish and structuring something that makes sense for them, because like just as an example, the guy with the installment sale, he doesn't owe any money on the property. That's the thing you've got to keep in mind. If you're 80% leveraged, you can't do
No, that's why. True. So hey, do you have advice for newbie investors, beginner investors, on what they should be doing when they're starting out, just to keep in mind how they're going to hold the property, etc., or what should they do while they're holding the property from tax perspective?
Yeah, well, new investors, need to put a good team around them, right? So you hear this all the time, right? But it's true. That's why you hear it, right? So you need to have a good real estate attorney. You need to have a good real estate CPA, right? And that goes for a banker, an insurance agent, and all of these things, right? I always tell people, and there's going to be people who disagree with me, but I think you should own a couple of small properties to see whether you're going to like being a real estate landlord, flipper, whatever, before you jump in big. And I know there's people out there who just teach jump in big, right? But I've had clients I had a client one time who was like the guy who owned a whole bunch of pizza parlors, right? And he wanted to get into the real estate business, and he goes out and he buys like a 75-unit apartment.
Oh, wow.
And 3 months later, he's like, I'm selling this thing. I'm like, why? He's like, I'm miserable. This is not for me. Well, you would have known that if you had bought a 3-family.
Right.
You would have known you didn't like being a landlord, right? So I tell people, look, start with something.
Yes.
Right? Start. Go out and do what I did. Go out and go out and buy a property or two, right? Don't spend 3 years, with your nose in books and going to seminars or whatever.
Yes.
You still want to do that, but you want to do that in conjunction with active investing, not.
And you get to apply the knowledge you are learning, right? So that's what I did, and I totally agree with you. I do not recommend buying something big. I started with 1 single family to 2 single families. Once I reached 5, I realized I got to scale up. Then I moved into duplexes, triplexes, and then I bought a 9-unit. So my growth has been slow, but I'm okay with that because I have always taken action. Every year I have closed on a property, right? So it's taking the action is very important. You don't have to take massive action, right? But you got to make sure you understand what you're getting into. Even when people are investing with me in syndication, I explain them that there is a lot of nitty-gritties in syndication. If you own even one rental property, you would know what we are talking about. Now multiply that by 100, and you would see why syndication, it has a lot of work for the syndicator, and for you, it's passive money, right? So, great advice.
Yeah, and most of the really good syndicators that I know started out exactly what you're talking about, right? Starting out, they're your story exactly, right? They start with a couple of single families, they buy a little bigger, they get a little bigger, they get a little bigger, right? And they figure it all out, So that's how you build a track record, right? That says to somebody, I know what I'm doing, investing.
Yes. Yeah, no, that's the key. So this is great. So let's take a quick break, Ted, and then after the break, we'll go to the fire round.
Okay, sounds good.
Welcome back to Wealth Matters Podcast. I have with me Ted Lanzaro, CPA, real estate investor, broker, etc. And We discussed about some of the tax strategies for real estate investors. Of course, in his book, The Tax-Smart Landlord, he covers all the strategies in detail. So this last part of the show, we'll go through the fire round. Are you ready, Ted?
I'm ready.
Okay. Would you be changing any business or investment strategy after coronavirus?
I think everybody is going to do that. I definitely will be. I know I'm a lot more careful with looking at numbers for flipping right now. And we have a pretty hot market here in Connecticut because a lot of New Yorkers are moving to Connecticut.
Yes, that's what I
Out of
heard.
the city. But even so, when coronavirus hit, when I was looking at flips, I was allocating a year to sell them instead of what I would normally do.
Wow. Okay.
Right, just because I was afraid. I didn't know what the market was going to be.
Right.
So I probably would go back to 6 months, and I think you're also going to see landlords, particularly, kind of maybe tightening up their screening process,
Right.
tenants, because of the
Yeah.
moratoriums and that sort of thing.
Right. No, that's great. Favorite real estate, finance, and I heard personal development, any other related book?
Oh yeah, I'm reading a motivational one right now called "You Are a Badass."
Oh, yes.
You Are a Badass series, and it's pretty
I
light
did read
reading,
that one. Yeah.
but it's pretty motivational. It's funny,
Yes.
So I like that one. Vinny Chopra's got a new book about positivity.
Oh, yes.
That I just got. It actually debuted the other day, and I kind of, that was a quick read. I went through that one, and very good. I like reading his stuff, and Robert Kiyosaki, can't go wrong.
Of course.
Think and Grow Rich.
Yes,
Right?
Think and Grow Rich and How to Win and Influence Friends. Those are some of the classics. Those are classics.
Love all the Brian Tracy stuff.
Oh, yes. Oh, yeah, yeah.
I use it extensively in my
yeah, Eat That Frog, right?
Presentation.
Yeah, Brian Tracy's that book I loved, Eat That Frog.
Is that one his? You're probably right. I don't remember. I know I've read that one. But he's got another one about putting together presentations. That's just.
Oh, really? Okay, I got to check it out. Any tool or website you recommend?
Yeah, it's really. Real estate websites?
Yeah, any tool or website you use heavily or you highly recommend,
Well, look, I mean, I think joining Facebook groups that are real estate specific, you can get a lot of information from. Bigger Pockets is a great resource. And then there's just a lot of people who've got their own kind of resources on their websites, so going around and looking at all the people, there's a lot of excellent coaches out there who are doing syndication stuff and real estate investing stuff. I think you should check them all out.
That's great. How do you give back?
How do I give back? You know what? I do a lot of charitable kind of contributions to, various sources. And I also, I love animals. So
That's
I donate
awesome.
to a local animal shelter, because I like dogs, essentially.
Nice.
I can't have one where I live, so it's nice to have a part-time dog once in a while just to play with.
That's great. How can my listeners reach out to you?
You can go to my website, www.lanzarocpa.com. That's where you can get a free copy of the Tax-Smart Landlord, a digital version. And there's also a whole bunch of podcast series that I've done. So there's a lot of my videos on the website. And there's also a Work with Ted page there, which will give you information on how you can work with me. And potentially become a client of Lanzaro CPA.
That's awesome. Thank you so much, Ted. Have a great weekend.
Thank you so much for having me. I appreciate it.
Absolutely.